Okay, so you want to own a hotel. Picture it. 150 rooms, a marble lobby, a rooftop bar packed every Friday night. Every room is occupied. Every guest checks in, sleeps, checks out, and leaves behind another few $100s. You start doing the math. 90% occupancy. An average room rate of $200 a night. That's roughly $27,000 in revenue every single day. Nearly $10 million a year. Read that number again. $10 million. It sounds less like a business and more like a machine that prints money. And that's exactly where almost everyone gets it wrong. Because a hotel doesn't make money by renting rooms. It loses money trying to keep them rentable. That's the distinction almost nobody sees until they own one. A hotel isn't one business operating inside one building. It's 5 businesses competing inside the same building. A restaurant, a commercial laundry, a 24-hour maintenance operation, a security company, a hospitality business that has to deliver a flawless experience every single day, whether the guests notice it or not. Every one of those businesses has its own payroll, its own equipment, its own operating costs, its own problems. The rooms generate the revenue. Everything else competes to keep it. So you might think the solution is simple. Just subtract the costs. Except the costs don't arrive as one big bill. They arrive every hour. An elevator breaks, a boiler fails, a roof starts leaking, a guest demands a refund. Housekeepers call in sick, utility prices rise, occupancy falls, and suddenly, the building that looked like your greatest asset starts behaving like your biggest liability. That's the paradox of the hotel business. From the outside, it looks like you're selling rooms. In reality, you're buying reliability. And that's the economics nobody puts in the brochure. At first glance, every hotel looks like the same business. Rooms, guests, check-ins, check-outs. In reality, the hotel industry isn't one business at all. It's 4 completely different economic models that just happen to rent rooms. Tier 1, the budget and economy motel. Think roadside properties near highways, 20 to 50 rooms. Buying an existing property typically costs between $1 and $3 million. Thin margins, high occupancy, minimal staff. You're not selling luxury, you're selling convenience. It's less a hospitality business than a real estate business with a reception desk. Tier 2, the mid-scale branded hotel. Think Hampton Inn or Holiday Inn Express. Around 100 rooms, backed by a national brand, costing roughly $8 to $20 million to build or acquire. In exchange for instant recognition, you accept franchise fees, mandatory renovations, operating standards, and thousands of pages of brand rules that influence almost every decision you make. Tier 3, the full-service commercial hotel. Restaurants, bars, convention halls, meeting rooms. These properties range from $30 million into the hundreds of millions. At this level, rooms become just one revenue stream. You're simultaneously operating a hotel, an events business, and a food and beverage company, all inside the same building. Tier 4, the luxury flagship. 5-star resorts, landmark city towers. Development costs start around $200 million and can easily exceed $1 billion. Here, the room is often just the ticket in. The real product is exclusivity, experiences, premium services, and a brand guests are willing to pay a premium to be associated with. 4 tiers, 4 completely different businesses. And here's the mistake first-time investors make. They think they're choosing a hotel. They're actually choosing an economic model that determines where every future dollar will be earned and where every future dollar will be spent. Let's talk about what it actually costs to open the doors. The purchase price is the number everyone remembers. It isn't the number that matters. The real spending begins the moment you take ownership. An aging property has to be brought up to brand standard, often costing $15,000 to $25,000 per room in renovations alone. Then come the furniture, fixtures, and equipment, another $10,000 to $15,000 per room. On a 100-room hotel, you've quietly added $2 to $3 million before welcoming your very first guest. Now here's where the economics break down again. Most people think those renovation costs are the biggest financial hurdle. They're not, because renovations are temporary. The hidden costs are permanent. Liquor licenses, health department permits, fire suppression inspections, specialized insurance, compliance audits. None of them disappear after opening day. They return year after year, turning what looked like startup costs into lifelong obligations. Then there's the building itself. Hotels don't wear out because they're old. They wear out because they're always working. Every occupied room means another shower, another flush, another air conditioner running through the night, another elevator ride, another door opening and closing, another mattress absorbing wear. Thousands of tiny moments, repeated every single day, slowly turn into million-dollar replacement bills. And the brand doesn't care whether you're ready. If you're part of a major chain, renovation cycles arrive every 7 to 10 years. Carpet, furniture, bathrooms, technology, signage. If the brand says upgrade, you upgrade, or risk losing the flag that brings guests through the door. So the real cost of buying a hotel isn't the purchase price you saw online. It's the purchase price plus the millions waiting behind it. Because in the hotel business, buying the property is the cheapest check you'll ever write. Here's the part almost everyone gets wrong. Most people think hotels make money by filling rooms. They don't. They make money by pricing the same room differently. That's the real business. The industry calls it yield management, the art of selling the exact same room to different guests, on different nights, for completely different prices based on demand. Think about it. On a quiet Tuesday in February, that room might sell for $90, just enough to cover the cost of servicing it. A few months later, during a major concert or convention, that exact same room, the same bed, the same view, the same square footage, might sell for $400. Nothing about the room changed, only the price did, and that difference is where the economics begin. Then come the revenue streams most guests barely notice: parking, resort fees, early check-in, late checkout, minibar markups that can run 3 or 4 times retail. None of those require another room to be built. Most require little or no additional space. Many add very little labor, yet they generate some of the highest margin revenue in the entire property. Now look at the daily economics. Servicing an occupied room, housekeeping, utilities, laundry, amenities, and everyday wear might cost roughly $30 to $50 a night. Everything earned above that is where margins begin to expand. Higher room rates, smarter pricing, better occupancy, more high-margin add-ons. Those are the levers that separate an average hotel from a highly profitable one. Because hotels don't become exceptional businesses by selling more rooms. They become exceptional businesses by extracting more value from every room they already have. The room is the inventory. The pricing engine is the competitive advantage. So if the economics can work, why do so many hotel owners still go broke? Debt. Almost always debt. Hotels are among the most capital-intensive businesses you can own. So most purchases are financed with heavy leverage, often 70 to 80% debt to value. That strategy works beautifully when occupancy is high. The moment demand weakens, it becomes brutally unforgiving. Room revenue can fall overnight. The mortgage payment never does. The bank doesn't care if occupancy drops to 40%. The payment is still due on the first. That's how profitable hotels become bankrupt hotels. Take the Revel Casino Hotel in Atlantic City. It opened in 2012 after roughly $2.5 billion in development costs. Less than a year later, it filed for bankruptcy. It filed again the following year and shut its doors in 2014. The problem wasn't simply attracting guests. It was carrying a debt load so large that even respectable revenue couldn't support it. The same story played out across countless boutique hotels that expanded aggressively just before 2020. Their business plans assumed travel demand would keep rising. Then travel stopped almost overnight. Revenue disappeared. Debt didn't. And that's the mechanism. Revenue is flexible. Debt is not. One moves with demand. The other ignores it. The moment those two lines move in opposite directions, cash flow collapses. There's no room to adapt, no time to recover, and no margin left for mistakes. Over-leveraging doesn't just increase risk. It removes your ability to survive the one bad year that every hotel eventually faces. So, what's the real number? In the best-case scenario, a well-run mid-scale hotel can generate a net operating margin of around 30 to 35%, with owner-level profit, after debt service, landing somewhere between 8 and 12% of annual revenue. On a property generating $10 million a year, that's roughly $800,000 to $1.2 million in real profit. Sounds impressive. Now here's reality. Most owners don't operate in the best-case scenario. After brand fees, rising labor costs, maintenance that always seems to arrive early, staffing shortages, insurance increases, and occupancy that rarely matches the original spreadsheet, many hotels settle closer to 4 to 6% owner-level profit. On that same $10 million property, that's roughly $400,000 to $600,000 a year. Still profitable, just nowhere near the fantasy. And that gap between the optimistic projection and the realistic outcome isn't bad luck. It's the business. It's negotiated vendor contracts. It's retaining good staff before they leave. It's forecasting demand accurately instead of hopefully. It's refinancing debt before interest rates move against you instead of after. It's making hundreds of small decisions that guests never notice, but owners feel every single day. That's why owning a hotel was never really about hospitality. It was always about controlling an expensive, constantly depreciating asset while trying to maximize revenue from something that changes every night: demand. So here's the real lesson. Hotels don't make fortunes because they have rooms. They make fortunes because they're managed better than the hotel across the street. The revenue gets you into the game. The execution determines whether you stay in it. Because in the hotel business, the building is only the investment. The operation is the business.